chapter. This is chapter number 10, Code of Conduct. So in this chapter, we will see the guidelines that are mentioned in order to have an ethical framework of managing the customer account, and what are the regulatory grievances mechanisms, and what is the resolution framework. So these are the learning outcomes. What is SEBI's Code of Conduct? Grievance redressal, online dispute resolution, IPF, and what is the authorization frameworks. So SEBI's Code of Conduct for brokers. What is Code of Conduct? That is principles. So these are the principles by which the brokers should adhere to. The broker should adhere to these principles, like act with integrity and fairness in all transactions. So no preference to any single customer. It should be fair for all customers. Maintain transparency. Ensure proper disclosure of risk and charges. Nowadays, you must be seeing that whenever you're trying to trade into any derivative instrument, the brokers are giving a message that the derivatives are a risky instrument. Protect client interest and confidentiality. Comply with all regulatory requirements that is laid down by SEBI. Maintain adequate infrastructure and systems. That means whenever there is a peak in the market, a lot of trading is happening, the system should not fail and it should maintain the infrastructure. Second is, what are the broker obligations and standards? So this chapter is more or less self-explanatory, but we'll just go through the important points that are important for exam. What is the broker obligations means? This is mandatory. Client documentation, KYC, risk disclosure, and transaction details as per regulatory requirements. This is fairly self-explanatory. KYC is one of the important part for client documentation. Risk disclosure, the brokers should be disclosing the risks that are involved in derivatives. Timely, they should inform the customer about the margin calls. They should maintain the transparency of the transaction with the customer. Fair dealing, execute orders promptly and fairly, ensuring best execution, avoiding conflicts of interest that could disadvantage clients. So here they are saying that suppose a broker, suppose a stock is very volatile and it's in the news, maybe it's getting acquired by some company. And now what happens? The broker wants to buy this stock in his own account also. Suppose the stock is XYZ. The broker wants to buy this stock in his account. And at the same time, clients are also placing the order, right? So the broker should not, indulge into any activities of, ignoring or, giving his own trade more preference than the customer trades. And he should deal fairly with each of the transactions. Fee transparency, clearly communicate all charges, brokerage fees and other costs. So these are involved in your trade contract. So whatever the trade contract that the broker is sending, it should have the breakup of all the fees that are mentioned in the transaction. What are the professional conduct standards? Competence and capability. That means qualified. Broker must be qualified. They must ensure staff possess adequate knowledge, qualifications and certifications like the NISM certifications or the BCDE certifications. Client suitability, that is risk profiling of the client, whether the client is risk averse, is aggressive, he is moderately aggressive. It should not happen that a risk averse customer is being offered derivative product, right? Because he's a risk averse customer and he's not interested in taking any of the risk. Conflict management, identify, disclose and manage conflict of interest. As I mentioned in the previous example, suppose a stock XYZ and the broker also wants to buy it, or the broker already has the position in this one and he's recommending this stock. So when he's coming on the TV or he's coming on any news channel, he should be disclosing it to the customers that he already has position in this company and he's still advising it, right? But he should always disclose that he has the position in this company. Market integrity, refrain from manipulative practice. Manipulative practice is like pump and dump schemes. You know that a lot of brokers, they pump the stocks and they dump it once the retailers buy it. They should refrain from insider trading, that is acting on information which is not public. Insider trading means acting on information which is not public. So these are the professional conduct standards for brokers. Second, what are the ways for the investors to raise their grievance and what is the redressal mechanism? SEBI established a comprehensive multi-tiered grievance redressal framework to address investor complaints effectively. This is the hierarchy: 1, 2, 3, 4, 5. So in this priority, the grievance can be addressed. First is you raise it to your broker. If this does not get resolved, you raise it to the stock exchange. If this does not get resolved, you raise it to SEBI scores platform, which is a grievance redressal platform. If that also does not get resolved, you go for the arbitration proceedings. If that also does not resolve, you can send a notice and get into a legal battle with the broker. The very first one is the broker resolution. Investor can complain to the broker. The broker takes time to review what is the complaint. The broker, if he finds that there is an issue at his end, or this was just because of market issue, the market itself was facing, the market infrastructure was facing the issue, he might provide the explanation for this issue. So brokers are required to maintain dedicated grievance redressal officers and display contact information properly. They must acknowledge complaints within specified time frames and provide regular updates on resolution status. So this is important. They should have a resolution team. They should have a support number. They should have chat support and other things which are mandatory these days. And they should always keep a record of all the transactions. Record of all the transactions and record of all the complaints and records of all the calls that the customer are doing to complain about any issue. If the broker is not able to solve it, you can raise it to the exchange. You can submit it to the exchange. So if you go to NSE and BSE, there is a menu which is only for the grievance management. Here you can place the issue. You can you can define the issue. You can also give your trade ID if it is done through the NSE portal or through the BSE portal. So whatever is the corresponding trade ID, you can give it to the NSE and BSE, and NSE will investigate and they will try to mediate. What happens is NSE will call the issuer, the investor and the broker at its own premise, and they will try to mediate the issue. Exchange will try to mediate the issue between the investor and the broker. If the issue is resolved, NSE will pass a resolution. If it is not resolved, the investor can go to the level 3 for raising his grievance. What is the level 3? Level 3 is SEBI scores platform. It's a centralized system. Here you can you can file a complaint online through the portal, adding the supporting documents. What could be the supporting documents? It could be a trade or the contract ID. Real-time updates, automated notifications keep investors informed about the complaint status, whether it is resolved, it is rejected, it is accepted. All those status is known to the investor. All complaints are recorded in a central repository accessible to SEBI and intermediaries. Intermediaries means the broker. So SEBI's score system will also inform the corresponding brokers about the issue raised against them by the investors. If this is also not able to solve, you can move to the next arbitration process. But let's see what are the features of the scores platform. Easy registration, you just have to go and register based on your PAN. Direct communication channel between investor, intermediary and SEBI. Parties can exchange message and clarifications within the platform. It is time bound. SLA, service level agreement, that is time bound. They have to revert back in 1 day, 2 day, depending on whatever is the service level agreement given over there. They have to revert back and close the issue within the given timeline. There is a facility to upload the document, so you can upload your contract notes. And this is as simple as it's mentioned over here. You can monitor the status, and there is a closure mechanisms. Complaints are closed only after investor confirms. This is important from exam perspective. Complaints are closed only after the investor confirms that the issue is resolved. So it's quite an investor friendly portal. Next, if the scores is also not able to solve it, you go to the arbitration process. When complaints remain unsolved through the normal grievance channel, investors can opt for arbitration proceedings conducted by stock exchanges. This provides a faster, less expensive and alternative to court litigation. Stock exchanges maintain panels of qualified arbitrators who hear the dispute and pass binding awards. The arbitration process is governed by specific rules and procedures, ensuring fairness and transparency. What are the advantages? Faster, low cost, expert guys who have the information and knowledge about the trading and the exchanges, binding decisions that is enforced by the law. Once the exchange says that this is the final decision, neither the broker can contest, neither the investor can contest. But still, if the investor or the broker wants to contest, they can take the legal route. But as long as they are doing the arbitration, whatever the exchange says, that is the final thing. Confidential proceedings protecting privacy. This is often done in the exchange premises. Flexible procedure adapted to case needs. So here the guy who is doing the hearing and who is going to give the decision will actually listen to both the sides, and he will come to the conclusion as to what was the issue based on the facts and the documents that are provided. Next is the ODR, online resolution of disputes. SEBI has introduced ODR to further streamline complaint resolution in the Indian securities market. The digital first approach leverages technology. So it was first introduced in 2020. This is the timeline in the last 5 years how this has involved. In 2025 it is fully implemented. So this is important from exam perspective. This is a self-explanatory slide. I can wait over here for 5 seconds for you to understand, but this is more or less a self-explanatory slide. So what are the features of ODR? Automated negotiation. AI-powered system facilitate initial negotiation between parties, suggesting settlement option based on the similar cases and market practice. Online mediation. So here you don't need to travel to the exchange and sit in front of the person and explain. You can actually do a virtual meetings within the platform itself, and you can put forward your issue. Everything is digitally documented. Complete case management including evidence, file submission, hearing records and awards. Online arbitration. Arbitrators can hear case virtually, review and pass the awards online. So you don't need to actually be physically present over there. What are the benefits? Since it is online, anyone can access it, across India. They don't need to actually go and travel to the exchanges premises. This benefits the tier 2 and tier 3 cities. Time efficiency. Since it is completely digital, it saves a lot of paperwork and time. Cost reduction. Travel expenses are nil because this is online. So a lot of travel requirements are gone. A lot of paperwork is gone. So this is a complete cost reduction. And there is complete transparency because everything is online and it is transparent. So this is more or less in line with what the scores platform is also doing, but here it is an enhanced version, and it integrates with the scores platform seamlessly, and this platform is being evolved on year basis. New features are being added more and more to protect the investors. What is the technology? This is not important from an exam perspective, but important for your own knowledge. They are built on secured cloud infrastructure, ensuring 24/7 availability. It has secure video conferencing, digital signature, multi-language support, mobile responsive, and integration with the SEBI score system. As I mentioned in the previous slide, it is seamlessly integrated with the SEBI's score system. Next is, what is Investor Protection Fund? Investor protection funds are established by stock exchange to safeguard investors' interest in case of a broker default. These funds provide financial compensation to investors who suffer losses due to broker failures, ensuring market confidence and stability. All investors trading through exchange members are automatically covered under the IPF protection, 100%. The maximum claim that the per investor can do is 25 lakhs, and broker has to contribute 1%. Broker have to contribute 1% of their net worth to build and maintain the investor protection fund. What is the structure and the funding? The IPF has exchange contribution as the first layer. Exchange puts in the money, say suppose 10 million, example. Then multiple brokers will put in the money, say suppose 8 million. The fund that they have will also generate income. So whatever income is getting generated, that also will get added, say 2 million. The fines and the penalties that are levied on the brokers will also get added into this fees, say another 2 million. And there's a lot of donation because this is a non-for-profit kind of a thing. So a lot of grants and donations come in, say another 2 million. So this will be the structure. Total 24 million funding, for example, in this case. And this is the breakup of the funding. So IPF is basically to protect the investors. In the case where the broker defaults. What is a claim process? Broker default declaration. Exchange declares a broker as default after due investigation and verification of financial irregularities. Exchange publishes public notice in inviting claims affected by the inviting claims from the affected investors who were trading with this broker. Then you have to submit the claim, SEBI will verify it, and then it will disburse the amount, maximum up to 25 lakhs. What are the limitations? First, what are the covered scenarios? Broker fails, so this is through the broker insolvency. Misappropriation of client securities or funds, client money is used by the broker. Unauthorized trading in client accounts without the client permission, the broker is trading. Failure to execute client transaction if the client has the recording or he has some proof that he told the broker to sell his position or buy his position and the broker has not done it. In that case, this scenario is covered under IPF. Non-settlement of legitimate dues. Suppose there is 2 lakh rupees in your trading account. Now, by the virtue of law, at the end of the quarter or at the end of the month, this money has to be transferred back to your savings account. If the broker fails to do this and you complain back to the broker and there is no resolution, in that case, IPF will cover the losses. What is the exclusion? Market losses, obviously, that will not be covered by the IPF. Trading losses, again, will not be covered. Claim against solvent functioning brokers. If the broker is solvent, then IPF cannot be used, but you can still use your legal course. Losses from unauthorized trading by the client. If the client itself is losing its username and password and someone has accessed it and done the trading, IPF is not liable for that payment. Claims filed after deadline expiry and amount exceeding the prescribed limits, 25 lakhs in this case. So fairly, simple thing to understand what is the IPF coverage. Then we have the POA from framework, this power of attorney. It's a legal instrument through which a client authorizes a stockbroker or DP to operate their trading and Demat accounts. SEBI has established strict guidelines to prevent misuse and protect investor interest. Optional nature. Execution of POA is entirely optional. Clients can trade and settle transaction. Limited scope. POA should be limited to specific purposes like facilitating settlement and margin obligations, not general account operations. All brokers must clearly disclose the POA relationship. Otherwise, what can happen? The broker can use the client funds for his own trading. Clients retain the right to revoke POA. So today the client has given the POA to the broker, but tomorrow he can say, hey, I don't want to, give you any more rights to trade in my account, and I'm revoking the rights for you to do any kind of transactions in my account. So this is a simple POA framework. And what are the guidelines? It's a standardized format. SEBI prescribes standard POA formats that broker must use. No custom formats are allowed. The format clearly defines permissible actions and limitations. Risk disclosure, broker must provide comprehensive risk disclosure explaining potential misuse scenarios, client rights, and alternative settlement mechanisms. Surveillance, exchange and SEBI conduct regular surveillance on trading patterns. Strict operational controls including transaction limits. Suppose the customer has say 5 crore in his account, but he has told you anything above 1 crore you need to take my permission, so he can put a 1 crore limit. Client confirmations, this is through the OTP. And audit trails must be maintained. Brokers cannot use PA for unauthorized transaction. Obviously, it has to be authorized and okayed by the client. Next is what is Demat debit and pledge instruction, DDPI. SEBI introduced the DDPI mechanism as an alternative to POA, providing clients greater control over their securities while facilitating smooth settlement process. DDPI allows clients to authorize specific operations without granting broad powers to the intermediaries. One-time authorization, client provides standing instructions to depository for specific transaction types. Say every buy will be authorized one time. One time they will authorize and the broker can do the transaction. Controlled access, authorized limit to settlement obligations and margin requirements only. All settlement and margin transaction only. No trading, no intraday trading, no FNO trading, nothing. Only these two types of transaction. Each debit or pledge verified against the client trading obligations is first validated. It's first validated. So this is quite common now. Anyone who is using a Demat account or a trading account will know that the DDPI, which is recently introduced 1 or 2 years ago, this allows you to do which allows you to the broker to do the transaction on your behalf, and you can define what kind of transactions are allowed for the broker to do on your behalf. And what is the comparison? DDPI limited scope, transaction specific, enhanced control, risk reduction, and transparency. POA has broader powers. Obviously, POA gives the right for the broker to trade and use your trading account and your Demat account. Traditional mechanism with established process, higher risk, potential for misuse is high because you have the full access to both the accounts. Subject to strict SEBI guidelines and surveillance. What does SEBI encourages? This could be exam question. SEBI encourages uses of DDPI over POA as it provides better investor protection. So if the question comes, which is the better investor protection? DDPI is the better investor protection. And this is fairly simple. What is the implementation process? So you have to submit the form. Client submits a DDPI form. The DP verifies it. System registers the registrations, linking the client account with the brokers. A confirmation is given. Again, this is also OTP based. And the broker can initiate the debit and pledges for settlement purposes. Clients can modify or revoke DDPI authorization at any time. So this is the flexibility which is available in DDPI, and this is everything can be done online, right? All the brokers have interfaces for this. What are the mandatory risk disclosures to the clients? SEBI mandates brokers to provide comprehensive risk disclosure. Market risk. So these kind of warnings should be available in the broker app or the web app that derivatives are highly risky instruments and you should only enter if you understand the transactions and the risks. What is the leverage risk? If the margin trade funding is used, the broker must inform the customer what could go wrong if the position goes against his transaction. Liquidity risk, information about potential difficulty in exiting positions. Now you know that if you trade on Zerodha and if it's a very thinly traded securities of which only suppose only 400 quantities traded within the day, Zerodha will give you a warning that this is a very low volume counter and do you want to still proceed and go into the trading. So these kind of liquidity risk notifications are required. Disclosure of technology failures. A lot of time exchanges also go down. A lot of time the brokers system might go down. So they have to timely inform the investors so the investors can take alternative routes to exit their trades. And what are the requirements? KYC, fairly simple, industry standard. What is the documentation? PAN, Aadhaar, address proof, passport size photographs, bank account, income proof, and additional documents for corporate and institutional clients. Basically, board resolution, key members, other things, right? So all these things are required for a KYC process. KYC is a one-time process across security market. Once completed with any one intermediary, the KYC details are shared to the central KRA. This is a record-keeping agency. Once you do your KYC, it is done and it is pushed to the KRA for fetching the details. What should be the content of the risk disclosure? General risk, derivative specific risk. Derivatives trading carries high risk due to leverage. Losses can exceed the initial margin deposits. Broker related risk associated with broker default. We have seen this. IPF covers broker default. Technology risk. It could happen that the entire bandwidth has gone down or the server has crashed, something has gone down. So these are technology risk. And the regulatory changes, like what can happen, like suppose now recently in the last 3-4 years a lot of FNO expiry dates have been changed from Tuesday to Thursday, from Monday to Wednesday, something like that. So these are the regulatory changes which can impact the trading rules and your limits. What are the client agreement and obligations? Client agreement clearly defines rights and obligations of both broker and client. Margin requirements, detailed explanation of margin requirements, that is initial margin as well as the maintenance margin. The broker should clearly communicate. Order execution, terms governing order placement, modification, cancellation, and execution. Finally, account statements. These are actually processed on daily basis. The contract notes and account statement are actually sent by the brokers on daily basis. What are the SEBI initiative in investor education and awareness? SEBI conducts extensive investor education programs. And what do they focus on? They focus on understanding different investment products like mutual funds, equity, derivatives, bonds, alternates, gold, ETFs. Risk assessment and management, identifying fraudulent schemes, so non-registered brokers. Rights and responsibilities of investors. What are the grievance mechanism? And what are the safe trading practices and cybersecurity? So this is fairly simple, could be a good scoring area in the exam, and most of us are aware of this SEBI initiatives for investor education. Lastly, we come to the conclusion. What is a comprehensive investor protection? First, there is a code of conduct for all brokers. They should follow this. Brokers should do a risk disclosure. There is an authorization framework. We saw that POA and DDPI are the two authorization framework. There is a grievance redressal mechanism, 5 layers. 2 platforms available, Scores and ODR for online complaints. And finally, financial protection, IPF can protect a single investor up to 25 lakhs. And there is an IPF framework. You have to submit your request and all your trade details and contract notes. And based on that, based on the deadline by which you have to submit this, IPF will process your claim after finding that the broker has actually defaulted or is now insolvent. So with this, actually, we finish our interest rate derivative section. This chapter is fairly simple and it is a self reading kind of a thing wherein you can read about the different code of conducts, the different risk disclosure requirements, documentation, KYC and other things. And this could be a good scoring area for the exam. I wish you all the best for the exam. Thank you guys.
All right, let's go through the answers. The first one is investors can have grievances against. The answer is all of the above. Most of you guys have got the correct answer. The second one is investor protection fund is the fund created to take care of legitimate investment claims. Again, most of you have got the correct answer. In fact, all of you have got the correct answer. And then we have the third one, which is arbitration is a quasi-judicial process. Again, all of you have got the correct answer. Fourth one is execution of power of attorney by the client in favor of a stockbroker is optional. Again, 90% of you have got the correct answer. The last one is subsequent to KYC, broker has to upload the KYC information in the KRA system. Again, 100% of you have got the correct answer. So as I mentioned, this is fairly simple chapter and self-explanatory. With this, we finished the Ignite series for your interest rate derivatives. Best of luck for all your exams.